Jones, and today I want to look at the formulas for ratio analysis. So I had explained in my previous video various formulas for ratio analysis in deep, and I gave some worked examples on the same, but they want to give purely formulas for all the ratios that we have in finance. So I'll be starting with the various classification, because the first classification I gave was the liquidity ratios, and I talked about the leverage ratios, I talked about the profitability ratios, and then the activity ratios. So I'm going to start with the liquidity ratios. Liquidity ratios. And under this one, we have the current ratio. Current ratio. And the formula here is said, let's take the current asset over the current liabilities. Current liabilities. Current liabilities. And I said the ideal ratio here is always ideal. Is always 1:2. Is always 1:2. Now the second one sort of covers the quick ratios. What is also referred to as acid test ratio. Acid test ratio. And this one here, the formula is the current assets minus stock over the current liabilities. Current liabilities. And the ideal ratio here is 1:1. 1:1. So that's the ideal ratio for the current ratio. The third one under this, the third one is the cash ratio. The cash ratio. And here, we're talking of now the real liquidity ratio. We say cash plus bank over the current liabilities. Over the current liabilities. Over the current liabilities. So here also the ideal ratio is of course 1:1. 1:1. The ratio for that. Now we're going to number 2. Which I said we have the second one that I want to look at here is the leverage ratio. The leverage ratio. The leverage ratio. And the leverage ratio here is leverage ratio is also one of them, and that's okay, the second one. And under this we have the total debt ratio, or the total liability ratio. And here the formula for this is the total debts or liability over the capital employed. Over the capital employed. That's the formula for the total liability of debt ratio. Then you have the debt equity ratio. Number 2 here. debt equity ratio. And here the formula I said is the net worth over the total debt there. Net worth over the total debt. The net worth, that means the equity over the total liabilities that we have. Now we have the capital equity ratio. The capital equity ratio. The capital equity ratio. Now the formula here is we take the capital employed over the net worth, or the net asset over net worth. Over the net worth. Number 4, under this we have the capital gearing ratio. The capital gearing ratio, and this one we let's say is fixed interest bearing security or fixed interest security over the capital or the equity share of the owner's equity. The fixed interest securities. Fixed interest equity over the owner's equity. Over the owner's equity there. So that gives us actually the capital gearing ratio. And that one I said is actually measuring the ratio between what we own and what we've borrowed from outside in respect of the assets that we have for running our business there. Then you have the interest coverage. Number 5. Interest coverage ratio. And then here the formula is we take the earning before interest and tax plus depreciation over the interest. Earning before interest and tax plus depreciation. That is more of a capital management. All over the interest. So that's the interest coverage ratio. Meaning the profit we are generating, we're comparing the interest that you're paying out to the persons who've taken loans from the fixed deposit in the fixed interest loans, they are securities, and then this relation between the two. So the last one under that, of course, that's what you have there as the leverage ratios. The leverage ratios relate to actually how we are financing our activities. Are we basing on mostly the outside funds, or are we basing more on our own funds? That's why you see most of the things here we are relating the loans from outside to the capital that we injected in the business there. So that's now under the leverage ratios. Now I'm going to the activity ratios. Activity ratios. This should be number 3. Activity ratios. So under activity ratios, we actually have several that already I explained there. So I'm not doing so much of the explaining, but I'm merely giving the formulas there. So, and I say this one, these ratios actually indicate how the resources of the farm have been used for generating profits, and I explained that, how we use the resources to generate income. Here we are comparing our own capital to the one we borrowed, the ratio between the two. Here we are actually seeing how we are actually our firm is liquid or having liquid cash able to meet its obligation. It's ability to meet obligations at any time it falls due. So we're looking at now how we're utilizing our resources, our assets to generate the income or profit that you have. So the first one here is what we talk of now as the inventory turnover. We talked about this. And I said turnover is always sales. So meaning we are relating the sales to the amount of stocks that you have. So here we always talk of the cost of goods sold or the sales over the inventory, over the average stock. We always sales over the average stock. Over the average stock. That one is always stated twice there. So we say sales or the cost of sales over the average stock there, or average stock that you have. That's the formula for inventory turnover. Then you have inventory velocity. Of course, the velocity is the speed, meaning at what rate are we converting stocks into sales. So we say this one will be taking the number of days in a year over the inventory turnover. Inventory turnover. 365 or 60 days, that's a year over the inventory turnover. Inventory turnover. That's inventory. So which gives a number of days there. Then we have the debtors turnover. Debtors turnover. The debtors turnover. And here we're relating to now the debts, the debtors. So here we talk of now the credit sales over the average debtors. Over the average debtors. Average debtors. Meaning we take the debtors at the start plus the debtors at the end over 2. Give us actually the average debtors we keep using here to calculate now the debtors turnover. Then you have the collection period. The debt collection period. This should be number 4. Debtors collection period. And this debtors collection period related to number of days in a year. So it's 360 days over the debtors turnover. Another 60 days over the debtors turnover. Over the debtors turnover. That also gives us actually. Yeah, so meaning using that, whatever we shall have calculated there, divided into the number of days in a year to give us the collection period, the number of days in a year. Then you have the assets turnover. Number 5 here. The asset turnover, and we said here we're relating net sales to the net assets. Now on top of net assets, that's actually also referred to as the capital employed. Now the asset minus liabilities. Asset minus liability give us the net asset there. Now we also have working capital turnover. Working capital turnover. And here, of course, you're taking on the sales over the working capital. So easy. Over the working capital. Working capital, of course, we said is the same as current asset minus current liability to give us actually the working capital there. Working capital. Then lastly, under the activity ratios, we have the fixed asset turnover. Fixed asset turnover. fixed asset turnover. Of course, here we talk of sales over the fixed assets. Over the total fixed assets there. Total fixed assets. So here we talked of the net assets, but here we're talking of the total assets. So fixed asset turnover, meaning we want to see how these fixed assets are actually helping to generate sales. That's what we talk of now, getting to there. That's what we talk of now as the activity ratios. The activity ratios, there are 7 of them. Now, we're going to the next one. We talk of now the profitability ratios. Profitability ratios. Profitability ratios. And this one also measures the ability of the firm to generate profits in any situation that may be prevailing at any time. So the first one is the gross profit ratio or the gross margin ratio. I talked about this. Number 1. The gross profit margin. And this one, we said the formula is actually the gross profit over sales times times 100. And I said here, you can see it's easy. When talking about now the profitability, the gross profit margin, merely how are sales helping you generate profit. That's what they said down here. Fixed asset, how are they determining the sales? Working capital, how are they determining the sales? Net assets, how are they determining the sales? And all that. After all these are merely relating the two. But all these are, you can see normally how to know how the formula appears. You merely look at what is determining the other one. It becomes so easy for you to understand those ratios, how they work. Now, we have the second one as the net margin ratio. The net margin ratio. So this one, of course, you consider now the margin. We say the net profit or profit before tax. Net profit is before tax over the sales times 100. Net profit before tax. Net profit before tax over the sales. Net profit before tax over the sales. Now, frequently is also referred as the net profit before interest and tax over the sales. Because that should be times 100. Net profit before interest and tax over the sales times 100 there. That gives us actually that net margin or net profit margin ratio. Now we have what we call the return on investment. The return on investment, those are profitability ratio here. And I talked about this one, the equations on the same. Return on investment. Now under return on investment, we have the earning before interest and tax over the net assets. So earning before interest and tax over the net assets. So net assets actually the employment, that's the capital employed. This one here, investment. So multiply that one by 100 there, times 100. Now lastly, under the profitability ratios is actually return on equity. Number 4. Return on equity, and this of course just relating to the profit after tax over the net worth. Profit after tax over the net worth. Those are actually the various formulas that relate to our ratios. Formulas that relate to our ratios. And I've covered virtually all of them there. I've covered all of them in that case there. And actually, that brings us to an end of the ratio analysis. What I'll be doing now is to look at questions. In my next video, I'll be actually computing questions, several questions, because in the previous video, I had done question on each of these. At least a question on almost all of them, not entirely all, but majority of them I had done actually questions which were related to them. So I'll be getting more questions. We shall have a session for questions where I'll have actually a question projected here, and then you can do questions together on ratio analysis, so that you can never have a problem on ratios. And as I was saying, you don't need to grant these formulas, you merely understand them. Like you're talking of the current ratio, which you merely know that this is relating to the assets and liabilities. So we'll be seeing that actually we're comparing the assets and the liabilities. For every liability, how many assets are there? And that's why you have the asset on top there, and then the liabilities down here. So for every liability, there are two assets. Here, that's the ideal ratio. Quick ratio, relating the current liabilities to actually those assets which are quick, you can convert them into cash back very fast. That's why you're minusing the stock from the current asset to get that ratio there done. The ideal ratio is 1:1. Cash ratios we're assessing now our liquid, real liquid position, meaning cash at bank and hand, relating to the liabilities there. So we need to grant that. Leverage ratio is saying total liability debt ratio, meaning we are actually comparing still the liabilities. So liability will be on top, but comparing with our own capital. That's now our own capital to the liabilities that we have there. Leverage is actually, or gearing ratio, is referred to that as actually gearing ratio. Leverage or gearing ratio. So we are assessing our gear, how we have geared or actually financed our activities. It depends so much on loans from outside, or depend more on our own resources that we generated through capital and will be retained earnings there. So that's why in each case you'll be seeing actually, we shall have our capital there, the net worth there, the net assets there, and also owner's equity, and then the interest you're paying out. So all this actually assessing how much of whatever we have is actually going out. Meaning if you have so much of the debt, then whatever profit generated we shall be paying for this cost of these loans that you're taking from outside. So that's the gearing ratio. If you have a higher geared company, then you find that when you generate higher profit, so much of you is going to pay the interest, and the very little remains to pay dividends to shareholders or the owners of the company. Now here, we're talking of the activities ratio, how utilizing our resources that you have to generate income. The same here, how able are we to actually generate profit in our farm? We shall be talking more of the same. That's it for today. Meet you in our next lesson.